All right, students, I am doing this video as a courtesy more to my online students than my face-to-face students, but this is actually a very easy, simple problem to work, and it has its basis in infinite geometric series. But this is about how a single bank, through what we call the deposit expansion process, is able to create more of the M1 money supply through booking loans. One of the things that needs to be understood right away is the following situation. That is that any time a bank lends money, the funds are deposited into a checking account, more properly called a demand deposit account, somewhere. And so that's what we're going to be dealing with here. We're going to do a little bit of background, and then we're going to work through a sample problem that is similar to the Unit 3 practice problem number 1. But for the online students, you'll be posting that in a forum today or tomorrow, whichever day it is in the Unit 3. So give me a second here to get this going. When I talk about creating money, I'm talking about creating more deposits in the M1 money supply. Commercial banks are not allowed to print currency. Currency is printed by the Treasury Department and circulated by the Federal Reserve. So the bottom line here is the only way a bank can create more money is through loans. And again, when the proceeds of loans are deposited into checking accounts, it creates more M1 because M1 is equal to currency plus demand deposit accounts. Another thing to understand is commercial banks only lend money if they have excess reserves. Remember, all commercial banks must keep a certain amount of money in the reserve account at the close of every business day. Currently in the real world, it's 10% of all their demand deposit balances. So that way there's always funds available to clear transactions for the checking account holders, or demand deposit account holders, we should say. But the issue here at hand is this. When banks lend more money, it creates more checking account balances, which leads to more lending, which leads to more checking account balances. And one of the things we know about checking accounts is those are spendable assets. Money in demand deposit accounts can be spent directly through writing a check, doing electronic debits with a debit card or an ATM card or an online bank pay or something else like that. Now, we're not going to worry about the kinds of loans here, but one of the things that needs to be mentioned is that every commercial bank has a balance sheet. And we call it a balance sheet because the total of the left-hand column must match the total of the right-hand column. Kind of like how on an old balance scale, the left pan and the right pan must have equal weights, otherwise the scale is out of balance. The assets are the things of value that are the property of the bank. They own these things. Most important asset is the bank's reserve account. We have to keep checking accounts at commercial banks to do our business. Commercial banks keep their reserve accounts at our central bank, the Federal Reserve, in order to be able to conduct their business. We'll talk about these in just a second. U.S. government securities are low risk, which is why 90% of a bank's securities portfolio or more must be U.S. government securities. Corporations can go bankrupt and settle their debt for pennies in the dollar or totally not have to pay their debt. And remember, when corporations sell bonds, this ends up being a debt they owe, but corporations will do strategic bankruptcies to avoid paying or reduce their payments. The U.S. federal government has yet to ever default on its national debt, hence lower interest rates but lower risk. Any loans on the asset column, commercial banks are loaning to people, to businesses. A loan is an asset to a lender because the borrower usually repays with interest. Over 90% of all borrowers, commercial and personal, repay their loans. So interest revenue is a lucrative line of business for commercial banks. And last but not least, of the major assets, any currency, or you call it cash, it's properly called currency in the bank's possession. There are other assets, but we're going to keep it simple for the survey course. So these four are the ones we'll work with. The two major liabilities. When you are liable for something, that means you are responsible for it. Like liability insurance is to pay for your financial responsibility in the event of a car accident. If you borrow something from someone else, you're liable for it if it's damaged, and you must make restitution. The thing is, the demand deposit accounts, or more commonly called checking accounts, belong to the account owners whose names are on there. And if a commercial bank, through a security malfunction or negligence, actually causes someone to have their checking account defrauded, that commercial bank will have to make restitution by recrediting all that money to the person's account. But this money belongs to the depositors, not the bank. The money goes in, the money goes out. It's a liability. Also, please notice the word from. Any loans in the liability column, the bank has borrowed from someone else. In this case, remember the Federal Reserve, one of its functions is to be a lender of last resort. Any outstanding loans a commercial bank owes to the Federal Reserve are liabilities. They are a debt they owe to the central bank. Yes, there are other liabilities, but we are going to keep this simple. We're going to work with just these two. Number one rule of the balance sheet: total assets equals total liabilities, or as the accounting professors would say, total assets and equity must equal to total debt and liabilities. We're just going to keep it simple here. That has to always be true. Now, remember about those reserve accounts. I said they're very important because of three major things they do with them. Most important thing, clear transactions for account holders. I don't think you would like it if you had money in your checking account, but because the bank maintained no reserves, they couldn't pay your check to some other bank and that check bounced even though you had money in the account. Well, neither does the Federal Reserve or the U.S. government, which is why all banks have to keep money in their reserves at all times. It can never go to zero. They would allow them to go to zero before the Federal Reserve existed, but the Federal Reserve wanted to ensure a stable banking system. They said, nope, fractional reserves are required. Another thing for the reserve accounts is any type of business conducted with the central bank. Ordering currency from the Fed or sending it to the Fed, they use the reserve accounts to do those transactions. The Fed does not lend currency. If a bank borrows from the Fed, money is credited to their reserve account. When a bank pays off the Fed, they tell the Fed to deduct or debit the money from their reserve account. Similarly, if the Fed were to do open market operations, sell a security to a commercial bank or buy it from a commercial bank, currency is not in the transaction. Banks will pay the Fed with using reserves for securities the Fed is selling to them. And if the Fed is buying securities from a commercial bank, they will credit the commercial bank's reserves as payment. Now, the part that matters most to us today, and especially to easy monetary policy, is a source of investable or lendable funds. A commercial bank creates more money when it lends out those reserves that go beyond the minimum requirements, the excess reserves, and so that's what we're going to be working with today. Now, some formulas to know. Everything that is lowercase is either a fraction or a terminating decimal. Everything that is a capital letter is dollars and cents, and mind your formatting. If it's $10,000 or more, that comma between the thousands and hundreds place is required. If it's a million or more, you got two commas between the millions and hundred thousands place, and then again between the thousands and hundreds place. Mind your formatting. Now, total reserves, and again, that's this item here. It says reserve account balances. We call those the total reserves in the bank, in that particular bank here. The total reserves is equal to the required reserves, which I'm using a capital R for, and the excess reserves, I'm using a capital ER for. The required reserve ratio is the fraction or percentage of demand deposit accounts that has to be in the reserve account as the close of business day. So the required reserve balances in dollars and cents equals required reserves times the demand deposit account balances, and the excess reserves is equal to the total reserves minus the required reserves. So we're going to go to a worksheet that I have not emailed you. This is just one we're going to be working with. Here's that funny fictional bank I like to make up called Gold Rush Bank National Association, or NA for short, National Bank if you prefer. Notice their total assets: $100,000 in reserves, $60,000 and 0 cents in loans, $65,000 and 0 cents in securities, and $50,000 in currency adds up to $275,000 and 0 cents. Check the liabilities: $200,000 in customers' checking account balances, demand deposit accounts we call them, plus $75,000 they borrow from the Fed equals $275,000. Notice total liabilities equals total assets here. Now, we're also told the required reserve ratio is 15% or 0.15. I really prefer to use the decimal for it. And we're also told the portion of M1 kept as currency, which I like to call lowercase c, is 60% or 0.60 as a decimal. So let's calculate the bank's required and excess reserves. And this is actually not that difficult. This is actually a very straightforward calculation here. So let's go ahead and do this here. I'm going to go ahead and do the little reveal step by bloody step here. Required reserves is equal to required reserve ratio of 0.15 times $200,000, the bank's demand deposit balances, which is equal to $30,000 and 0 cents. Now notice this bank has got $100,000 in their reserves. They have to have at least $30,000 in there. Since the total reserves is greater than the required reserves, we have excess reserves, which means this bank can lend out some money. So the excess reserves is equal to total reserves minus the required reserves. That's going to be $100,000 minus $30,000, which means this bank has $70,000 in lendable or investable assets. The maximum amount of money at this point in time that any loan could be booked for is $70,000. Of course, if there's a change in demand deposit balances and reserves, the excess reserves could be more or less, but we're going to look at this fixed point in time exclusively. So that's where we start from first. This bank can lend out $70,000. Now let's go back to the slideshow and talk about multi-stage money creation. Part of the way banks create more M1 is through lending. But imagine this situation I'm about to describe here. Gold Rush Bank loans out all $70,000. That money is then deposited into a second bank in the system. What is going to end up happening is Gold Rush Bank's loan portfolio will go up $70,000, but when that check clears to fund the loan, their reserves will go down $70,000, and so Gold Rush Bank can't lend any more money. But let's suppose the second bank in the system then gets its reserves and its checking accounts in order. That second bank in the system will have to set aside 15% of that $70,000, but they would have an additional 85% of it to loan out. Well, let's suppose they do that and deposit it into a third bank in the system. The check clears, and the third bank sets aside 15% and loans out the remaining 85%. Repeat that process through 5 stages. This is what we're going to get. After 5 iterations, the first bank, which is Gold Rush Bank, has loaned $70,000. The second bank has loaned out 85% of $70,000, or $59,500. The third bank has loaned out $50,575, 85% of the $59,500, or 85% squared times the $70,000. Next item, fourth bank in the system loans out 85% of the previous amount, and the fifth bank, same thing. Notice each new bank is loaning less money than before because each new loan is 85% of the previous loan. And we add up all 5 of those, that's almost $260,000 of more checking account balances created from one loan of $70,000. This, students, is a multiplier process. Now, some of y'all who have had pre-calculus or finite math will say, hey, wait a minute. 70,000 times 85% to the 0 power plus 59,500 times 85% to the first power, or plus 70,000 times that to the first power, plus 70,000 times 0.85 to the second power, plus 70,000 times 0.85 to the third power, etc. That is a geometric series. Now, the thing is, somebody a lot smarter than all of us figured out that if you have a geometric series where that common ratio, the 85% I'm talking about, is between 0 and 1, and each new number added is the original seed value, the $70,000 in this case, times 85%, 0.85 to higher powers, you could have an infinite number of loans if banks would lend out less than a couple $1,000s, and if, people kept no money as currency. And you could actually have a finite sum of an infinite number of terms because of the way those terms converge. Well, here's the thing. I'm not here to teach y'all infinite geometric series. So if you understand that, great for you. I do. But if you don't, some wizard smarter than all of us figured this out, and here's how we get the formulas. Boom. If all the excess reserves were loaned out by one single bank and they were redeposited to different banks, and each bank set aside required reserves and then loaned out the rest an infinite number of times, the potential money created, or capital M/P, is equal to the original bank's excess reserves divided by the required reserve ratio. Now, this factor, the reciprocal of the required reserve ratio, is called the potential or simple money multiplier. Please listen up, students. You will not use decimals for any multipliers. Multipliers are going to be either fully reduced simplified fractions. We will not use mixed numerals. This is not grade 3 math. Or they're going to be integers, positive integers like 2, 4, 10, or whatever. Okay? So we're going to deal with the potential money multiplier and the potential money created next in that problem. So we're going to go back over here. And again, because I'm the professor, I have staged this thing for y'all here. Let's start by calculating the potential money multiplier. The reciprocal of the required reserve ratio is 1 over 0.15, but that's a decimal. That's not kosher. Notice we have 2 decimals on the bottom and none on the top. 2 decimals. 10 to the second power, decimal 10, get what I'm saying, is 100. So if I multiply top and bottom by 100 over 100, 1 times 100 is 100. 0.15 times 100 is 15, and 100 divided by 15 is equal to 20 over 3. Do not make this a decimal. Do not make this a mixed numeral. The only correct answer is 20 over 3. So the thing is, this thing here, which is about 6 2/3 here, that is how much more money the system can create from one original loan based upon the infinite number of banks and all that other nonsense, which is silly. Think of this as an upper boundary. Now let's talk potential money created here. Let's do that big reveal next. Potential money created is equal to the excess reserves we calculated as $70,000 divided by the required reserve ratio of 0.15. And here you have to round to the nearest penny. $466,666.67. You have an infinitely repeating 6. Since the third decimal place is 5 or larger, you round up the second and make it 67 cents. This is how much money the system could, keyword, potentially create if we had an infinite number of banks, if nobody kept money as currency, if banks loaned out all their excess reserves, etc., and none of those things are true. That's the most money that could be possibly created in this situation. But let's get real. We have about 6 really big banks and a few hundred small or medium-sized banks. Most banks don't book installment loans for less than a couple $1,000s. People keep about half their money as cash versus, or currency, I should say, versus demand deposits or checking accounts. So we need to deal with something that's more actually relevant, and that's where the notion of the actual money multiplier comes in. Little c is the portion or fraction or percentage of money in the M1 money supply held as currency. Little ib sub a, the actual money multiplier, is 1 plus little c divided by the required reserve ratio plus little c. These will be given as either decimals or fractions, but you need to convert the multiplier to a fully reduced fraction. No decimals, it's either fully reduced fraction or integer, and we have the simplification method I've shown you here. Now, once you got the actual money multiplier, to get actual money created, you take the actual money multiplier and multiply by the bank's excess reserves. So let's go back to this problem that I created for y'all here, and we're going to deal with these one at a time. We're going to start with the actual money multiplier first. The actual money multiplier, 1 plus little c is 1 plus 0.60. Required reserve ratio 0.15 plus little c is 0.15 plus little 60. That's 1.60 over 0.75. Notice we have 2 decimal places, top and bottom again. 10 squared is 100. So we multiply by 100 over 100, which is technically 1, but we multiply across to get rid of our decimals. 100 times 1.6. I repeat, 100 times 1.6, that is going to be equal to 160. And then 0.75 times 100 is 75. The only common factor these two numbers have is 5. If I factor a 5 out of the top and the bottom, I get 32 over 15, and this doesn't reduce anymore. But I want you to notice that the original money multiplier was like almost 7. That's a potential one, I should say, but the actual is just a little bit more than 2. The actual money multiplier is a lot more realistic. Now let's talk about actual money created next. Actual money created is going to equal the actual money multiplier, which we just calculated, as 32 over 15 times the excess reserves we did at the beginning, which is $70,000. So we multiply the 70,000 by 32, we divide it by 15, and you round once again to the nearest penny, and that's going to equal to $149,333.33. Your calculator will show an infinite number of decimals, but we don't do that. The penny or the second decimal place is where we stop in the US dollars. So $149,333.33 is the correct actual money created. And notice it's about 1/3 of what the potential was. The potential way overstates things. This is much more realistic. Don't forget, commas between the thousands and hundreds place. If you don't see any decimals in your calculator for those monies for excess reserves or required reserves, don't forget your double zeros and mind your rules of rounding and formatting everywhere. This is not a difficult problem. This is actually fairly simple. And so I certainly hope that you will find this useful. All righty, so I'm going to close this thing up now here. And whoa, man, we got the tunnel. Success to y'all on this thing, and I'll see y'all later.